Hi, and welcome to the FXtrade.com Beginner's Corner. What is Forex? Well, the word stands for Foreign Exchange Market and describes the massive global market where trillions of dollars are traded on a daily basis between different participants. Some speculate, this is the case of traders like myself, and other participants in this market are just seeking to exchange a foreign currency, not to speculate, but because they need to exchange money for their business, like multinational companies, which must pay wage or other expenses in different nations where they sell or buy products in. In fact, that's the base of all forex trading, right? So, let's see a practical example of this that will make you easily understand what is the currency exchange. Then, we will see what are the main characteristics of this forex market, okay? Let's talk about a car company established in country A, where a local currency is currency A. It has to buy steel in country B, where the local currency is currency B. Before buying steel in country B, car company has to exchange its currency A to currency B. Exchange rate, that is how much one currency is worth in terms of the other, may change over time. So let's say that today exchange rate is 1 of currency A equals 2.5 of currency B. If in country B 1 ton of steel costs 500 of currency B, today the car company will have to pay 200 of its local currency to get that ton of steel. 1 week later, car company has to buy more steel, but the exchange rate has changed, and as we will see later, those rates are fluctuating all day long, all the time. So now 1 of currency A equals 2.8 of currency B. For the exact same product and the same quantity, the car company will now pay 178.6 of its local currency, paying less than 1 week before. That is due to the changes in the exchange rate that now goes in favor of the car company. Of course, this can go the other way around, as the fluctuations in prices are constant and goes up and down. Let's take another example of 1 month later. The exchange rate is now 1 currency A equals 2 of currency B. To buy the same ton of steel, the car company will now pay 250 of its local currency. Then it will pay more than 1 month before, okay? Those differences in prices is what the speculative traders of the forex market try to take advantage of. In other words, they speculate on movements in the exchange rate, taking advantage of every small fluctuation in it. Now that we have set the very basis of the exchange rate, let's take a look at the main characteristics of the forex market. We said that this is a bidirectional market. It has a high transaction volume, which leads to high liquidity. It has various and numerous participants. It's a market open 24/7, and it allows leverage to enhance profits in respect to account size. What means bidirectional market? Well, currencies are traded one against another and are presented in pairs. Each pair of currencies thus constitutes an individual product and is traditionally noted XXX, Y, where Y is the international 3-letter code on the currency into which the price of 1 unit of XXX is expressed. For instance, euro-dollar is the price of the euro expressed in American dollar, as in 1 euro, 1.38 American dollars. Bidirectional market means you can either choose to buy or sell this particular currency pair. You can choose to buy the euro against the American dollar with the expectation that the euro will gain value against its rival, or sell the euro and buy the American dollar, also called the greenback, with the expectation that the euro will be losing ground, that means value, against its American rival, and so be able to get more euros in exchange when you buy back your euros, okay? When talking about high transactions volume and high liquidity, liquidity means that there is so much money around that you will always be able to find a counterpart to exchange any currency, and buying or selling orders will be filled in questions of seconds. The Bank of International Settlements, that is an international organization which fosters international monetary and financial cooperation and serves as the bank for central banks, has published a triennial report back in April 2010 where it states that the average daily international foreign exchange trading volume was of about $3.98 trillion per day. This warranty a constant liquidity not seen in any other market across the world. As an example, Wall Street moves only on a daily basis $45 billion. That is almost 90 times less. When talking about various numerous participants, despite we have several ones in this market, it's Forex traders that occupied us here, right? Forex traders are either professionals working in a financial institution or a corporation, or individual investors that even trade from home. They buy and sell financial instruments traded in the currency markets, right? These traders need the help of a third party to access these transactions. That third part is known as broker, a firm or individual that executes the order to buy or sell currency contracts on behalf of clients and charges them a commission for that service. We are going to talk a bit more about this one later in another video, okay? When we talk about a 24/7 market, it's because there is always one market open, starting with the Asian session, following with the European one and the American one later. The fact is that there is always one market open that lets you be trading. As you can see, sometimes the sessions even overlap each other. Currencies then can continually be traders. When we talk about leverage, the fact is that investors are able to trade the Forex market with leverage. Leverage is having the ability to control a large amount of money using very little of your own money and borrowing the rest from the broker. This leverage allows the investors to have a much larger exposure on the Forex market than what his real capital permits him. This is both positive and negative. The trader can make significant profits larger than what he could do if he would engage the money he really possesses, but it also increases risk of significant losses, as he can also lose more money than what he could have. Okay, all of the above maybe makes of the Forex market the one closest to the ideal of perfect competition, yet of course there is no such thing as perfect. Remember, the closest, not the perfect one. Let me tell you now the disadvantages before I continue. High volatility, liquidity, and leverage. Yes, just the same advantages are disadvantages too. All these things can play against you as well as in your favor. So, why are we here? What makes Forex so attractive and so popular? Where is the difference? There's a non-written rule that says that only 10% of Forex traders are successful against the 90% that blow a count. That's quite scary, right? Well, to be inside of that 10% of successful traders, you need study, you need testing, you need planning. That's the only way for success.